All right, Pat and Joe, why don't we kick it off? We've got some colleagues piling in already. So hello and welcome to the latest Wall Street Blockchain Alliance global webinar presented by our friends and colleagues at member firm Bitwave. Today's webinar, the state of crypto, what's new in crypto accounting and taxes. Got some great guests and friends as part of this, but before we begin, a bit of housekeeping for today's session. This webinar is being recorded. All attendees will be in listen-only mode. Attendees, you are encouraged to submit questions for each session and part of the conversation throughout using the Zoom chat function. We will, of course, reserve time at the end for Q&A. Please keep in mind that this event is offered for general information and educational purposes only and is not intended to constitute investments, legal, tax, or accounting advice. Any views or opinions expressed during this event are those of the participants. Don't necessarily reflect the views of the Wall Street Blockchain Alliance or participants' firms. And Pat and Joe, you know I know way too many attorneys in my life. So it's great to have you both. We've got a deck here. We've got members piling in as well. I want to move forward. Pat, you and I and Joe go back a bit in this space, but tell the audience who you are, what you're doing, and then Joe will go to you as well.
Well, first off, Ron, absolutely wonderful to be here as always. This is always like one of my favorite things that we do. We do this like quarterly or semi-annually or something like that. It's like one of my favorite things to do because we just get on and we just chit chat about crypto happenings and stuff that's going on. So, hey everyone, my name is Pat White. I'm the CEO of Bitwave. Bitwave is a digital asset back office solution for everything from tax accounting, full subledger, everything you can imagine, AR, AP, adding lots of treasury management stuff lately. That's all the rage. So we'll talk about that. Downturns mean cash flow worries. So that's where you get into treasury management stuff. So we'll go over that. But my name is Pat. And it's wonderful to be here.
Pat, thanks for joining. Mr. Dillon, my East Coast buddy, how are you?
Very good, very good. So I'm Joe Dillon. So I'm our Director of Customer and Partner Success here at Bitwave. So that means I work a lot with both our, individual companies that are using Bitwave and as well as the accounting firms that are utilizing our platform. I came to Bitwave after about a decade in public accounting. So I'm a CPA and I look at a lot of what we do through that lens.
Pat, Joe, great. Thanks for having you both. So I remember when we were doing the prep session for some of this, we were trying to get down to what are some of the bullet points. And we said, what's new in crypto and looking towards 2023. And then my head kind of exploded, Pat, when I realized there's a whole lot there. So I want to kind of break that down a little bit. The three of us, we go back in this space a bit. We go back pre the 1040 having the line item about digital assets and the IRS having an FAQ that sporadically randomly gets updated. I kind of want to level set. And Pat, let's start with you. What is that state of crypto? I feel like crypto and accounting and taxes have gotten significantly more complicated in line with the complexity in the crypto space. Think NFTs and DeFis. What have you seen? You've been deep diving in this for a while. And then Joe, we'll open it up to you as well. We'll keep it conversational.
I think the easy stuff keeps getting easier. The hard stuff keeps getting harder is sort of the way I tend to think about it. More and more crazy things are coming to crypto every single day. And with it is increased, consternation around accounting treatments and stuff like that. I mean, one of the things that we picked up this year was, which we hadn't really dealt with before, we'll talk about a little bit, was deferred revenue on crypto for staking. So this is a really interesting piece where we have a bunch of customers that use Filecoin. The way Filecoin works is you get quarter of when you mine a block, you get a quarter of that up front, and then 75% of it vests over the next 6 months. And so this is a pretty classic deferred revenue example, kind of, right? I mean, there's nothing normal about any of this because you have to keep your node up. You have to keep your node up, and as long as your node stays up, you get to claim the vest. If your node goes down, you start to lose money, kind of like you would with the Ethereum 2. So, there's stuff like that that's just new models and people that are finally getting serious about accounting that had never really worried about it before. And when they go to Deloitte and they say, hey, look at this thing that we do, Deloitte's like, hold on one sec. Like this smells like something else that you have no idea exists because you're like an engineer and not an accountant. And so here's how you do it. So, but then the, a lot of the normal stuff that we do every single day, just revenue rec, mining is getting a lot easier to handle on a everyday basis. The rules have gotten really cleared up quite a bit. We'll talk about the FASB decision today. Any movement towards clarity of rules is good, but of course, the FASB decision, as we'll talk about today, it left like so many open questions that it's like there's still a million things for us to debate on these webinars.
Pat, thanks so much. Joe, what are you seeing?
Yeah, I think I'll kind of piggyback on what Pat said. I would say we're seeing the maturity, right, start to develop in the industry, both in line of like what Pat was mentioning with the FASB decision. We're seeing, obviously we know there's a ton of bills getting kicked around that, at some point we'll probably see something come through. We saw that FASB vote, and while it does open up a lot of questions, I think to me, that was really one of the first shoes to drop of like, okay, this is getting real. Like I am expecting, this incoming wave of regulation, and then which is part of that maturity. And I think like what Pat said, some of the infrastructure around the industry, some of the easier things are getting easier, getting information. What we see maybe in the accounting and finance community, the infrastructure we're seeing companies build around these processes, getting their ducks in a row from an accounting standpoint. I think that's what I would see. And it's really honestly my thought on the last 6 months really is we just keep chugging along. If you're not in this industry every day, you might think like, oh God, isn't crypto, is that dead yet? And it's like, my dad calls me like, is everything okay? And I'm like, oh my God, you have no idea all of the new things that are happening every day. Like the building is happening. It's cliche, but it's true.
I love the winters. I mean, honestly, like I know it might sound kind of silly, but like you see the scams just plummet. I mean, honestly, like scams, all that kind of stuff just plummets down during the winters. You see people working on really interesting projects, like people who are deep technologists that love this stuff, working on really interesting projects without a lot of the crazy expectations, the crazy like valuations, all that sort of stuff. I love the winters. There's so much cool stuff happening right now across the board.
Pat, Joe, and one of the things that you both mentioned, it's interesting. I feel like the ecosystem's evolved to the point where, and in the early days, it was, we don't need to worry about talking to lawyers or regulators or anything like that. And that kind of went away. Now it's like, holy crap, we really need to talk to our accounting professionals and vendor providers because there's a lot going on. So I think we're kind of at that point. And the other thing, you mentioned infrastructure, and we didn't put it on the agenda, but I'd love to peel that back a little bit. In the early days, it was a struggle to get quality normalized data, for example, and put that stuff together. Bitwave's done a lot in that space. Pat, Joe, can you speak to that a little bit? And what were some of those challenges? Because those are the tools the ecosystem needs going forward.
It's still, and for what it's worth, there are still challenges there. I think we've done a great job. We have a pretty, incredible, robust data set of everything you can interact with. But then there are places where this industry is incredibly immature, is sort of a way to say it. So for instance, a great example would be, one of the tools that we rely on pretty deeply is the ability for our customers to do on-chain balance checks on Ethereum, right? So we gather all your data, we put it into one place, we give you what we think the balance is. We then want to be able to go for a particular block and say, okay, here's what Ethereum thinks the balance is. And that's great. Ethereum and most of the EVM-based chains have that. When you get to chains like Solana, Cosmos, those guys don't have that. And so you end up with this kind of step back in terms of auditability and traceability for your actual data. So that's one part, is that we've tried to work really closely as new chains are developing. We actually try to get ahead of it and talk to those folks early on and say, hey, here are the things you really need. Like you need one endpoint that gives you really good data on an address by address basis. You need the ability to do a block level balance check in order to pick it up. And slowly people are kind of getting up to it on that side of it. Then the other side, of course, is I would say a lot of the enterprise, a lot of the products that we rely on are not mature also. So Coinbase, I'm going to pick on Coinbase just a little bit, even though we like them very much. They deprecated one of their APIs that was their custody API and moved it over to a different Prime, to their Prime API. That might seem like a really small thing. That causes an enormous amount of issues. Like once you publish an API, if in the real world, like crypto's not the real world. This is like fairy tale land where we
not yet.
As long as we all admit that. But in the real world, when you as a company publish an API, when Microsoft or Google publishes an API, they'll have a 1 or 2 year deprecation plan in place. Like if they're going to get rid of their API, they will send out a notice, they will mark it deprecated, and then over the next 2 years, they'll monitor usage to make sure people are not using it. and then they'll deprecate it. Coinbase kind of just did this over a weekend, and it broke one of our sinkers because it relied on that API. So there's things like that where we as an industry are still really maturing, and we're maturing our thinking, we're maturing our practices, we're just sort of getting more like, someone from an enterprise company that was the CTO, I don't know their CTO, so I have no idea, but like they are, it's sort of the maturation of the industry means picking more of those things up and just being better about it. It still is tough, but we do our best job and have added a lot of quality features to make sure that we're doing even better than we ever have.
What about volumes, Pat, Joe? I mean, are you seeing are volumes kind of hockey sticking? And I know we're kind of got this crypto winter going on, but a lot of the institutional players we talk about that rely on tools like what Bitwave provides are, holy crap, there's a lot of data coming in that we're ingesting. What does that look like for you guys?
I'll make a comment. So to me, and this has still been true, my opinion is like once an entity gets involved in the digital asset space, volume goes up. It just anyone who I've seen is like, okay, hey, we're going to dabble. We're going to hold, you start, there's like that meme of like, the dominoes falling. The first one is like, we're going to hold a little Bitcoin on our balance sheet. Right.
Yeah.
And then like, 5 dominoes later, they've got 200,000 transactions that they're trying to figure out how to sort out. And I think for me, obviously there are extreme cases like that. I think that's still generally true. I think as we see entities get a higher level of comfort and sort of that infrastructure piece gets built around them. So now their lawyers are getting more comfortable, their auditors are getting more comfortable, right? It encourages an increase of adoption, new activities. So I think I still see volume going up on a individual basis. I'd say.
Oh, incredibly. I mean, it's probably more than 20% of our customers are doing more than 1 million transactions a month at this point. If I had to kind of like really tease it apart. And honestly, I mean, it's one of those things that crypto is just so easy to transact in. I mean, we have customers who are maybe 18 months old. I always even like someone like OpenSea is doing 40, 50 million transactions a year. That's like a regional grocery store. I think it's not Walmart. Like Walmart does like 1 billion transactions a year. I think I looked it up at some point. So we're not quite to like the Walmart levels, but I think like, it's like Kroger's or something, or like, Kohl's or something like that. They're probably doing in the 1,500 million transactions a year, something like that. And that's a 40-year-old company that has had time to build up processes. Like 40-year-old companies go from 1 transaction to 10 to 100 to 50, they like actually, they grow linearly.
Linear growth, right?
Right.
Not kind of
Crypto companies go from 0 to 18 million with the same 1 person on the finance team or 3 people on the finance team.
That's right.
And so the expectation for a tool like ours to be able to handle the scale is just completely different than any other industry. I mean, like, and like the sort of like, it's not just the scale that you're handling, it's the manpower that has to drive the tool. Because like no one is hiring 40-person ARAP teams, and they don't have these enormous finance teams like someone like Kohl's would. They're doing it like efficiently as is sort of the crypto way.
Yeah.
Guys, we've got a lot to cover. Go ahead, Joe. I'm sorry.
No, go. That's great.
We've got a bunch to cover. We're going to talk about staking, deferred revenue, treasuries, Q&A. There's a lot more. And again, for our attendees, thank you for joining around the world. Please start entering your Q&A. We'll vet them and go through those towards the end. This was the late slide you sent me, Pat. You're going to kill me for probably putting this out of order a little bit. Do you want to talk a little bit about what we're looking at here?
So this is, okay, so this was, we want to spend some time talking about the FASB decision. And so the FASB vote was essentially that they're going to move towards fair value for digital assets. This away from the intangible asset treatment or impairment model. This is sort of what Joe and I think of as like the very pertinent part of that decision, because this is where all the devil in the details of the FASB decision was that they really did carve their decision out quite aggressively. So obviously intangible asset determination, that's fine. I'll skip number B because we'll talk about that a lot. Distributed ledger, that's fine. Security cryptography, all great. Fungible is probably the most important. So first of all, they said that they're only analyzing fungible tokens as part of this, or only including fungible tokens as part of this project, which means that NFTs are automatically out of that analysis. But we'll talk about that a little bit, which is even that's kind of squishy because NFTs might have other things. But B here is where things get really interesting, and where I like I'm really curious where we end up with making a determination about what is fair value versus what we still actually have to do an intangible asset treatment on. So as a holder with enforceable rights to claims on underlying goods, services, or other assets. So I think Ethereum and Bitcoin, I think you're pretty clear that don't fall into this. Like those, there is no rights that come along with owning an ETH. You know, you can use it on the public network as gas, but that's not really a right. But where it starts to get squishy would be things like governance tokens. You know, governance tokens do come with enforceable rights. Like they have voting rights, and oftentimes they have voting rights on treasuries. So the minute you have a voting right on a treasury, you basically have rights to spend money out of a treasury, which is implied an enforceable right to an asset within a treasury. So governance tokens start to get a little bit squishy. Some of the other things are tokenized out there, like Pax Gold is one we want to talk about. So Pax Gold is a token where I can, if I have one Pax Gold, I can trade that in for 1 ounce of gold. Like I can literally go to, they have a storefront. And I imagine it's more secure than like a storefront, but they have a place in Canada where you can go, you send them you give them your Pax G, and they give you back some bullion. I think you have to do like, they have a minimum of like 300 that you turn in. So it's like I don't know, like a couple pounds of gold or something. But anyway, I mean, the high level, like that is very clearly a fungible token, but with an underlying, with an enforceable right to an underlying, I guess you call it an asset or perhaps a good from that. Joe, you want to add anything on that piece of it?
Yeah, I mean, in the same lines, I think a lot of people are wondering just where do stable coins fit, right? If a stable coin is genuinely redeemable for US dollars, is that scoped out here? And I think
is there something really weird about this, that this verbiage carves out USDC but doesn't carve out like US the Terra?
Yeah. You know, and I mean, I certainly think we're going to get specific stablecoin regulation in one form or another anyway. But I think to take a step back, Pat, what you were talking about fits into this general idea I have of like, what does the FASB vote mean, right? It's like, one, it feels very pro crypto for people that have been in the space for a long time, in the sense it's like, finally, I can record these at fair value. This is what I've wanted to do all along. Is impairment dead, right? That's the question we're getting from customers. Like, hey, is impairment dead? And it's sort of like, pump the brakes. Like, let's see. One, you know, this was a vote. They still have to put out an exposure draft. They're still going to open it up for public, you know, comment letters. They're still going to, we're probably, you know, I've been saying like, we're 6 months away from like a genuine standards update. And then even then, what's the adoption period? Like, I think a lot of people in this case will want to early adopt, but what are you doing for 2022? What are you doing? You know, you still, and I think what Pat's speaking to is like, there are likely some carve outs here where I think this is sort of an indication of what our future might look like, which is that your digital assets that you hold are going to fall into a bunch of different buckets that require a bunch of different treatments, right? They're all, you know, one size fits all already sort of doesn't work with crypto accounting, but I think it's going to become more and more true. And I think as we see the professional, you know, accounting and auditing community opine on this, that's what I'm super interested to see. Where do the opinions start landing of what is in, what is out?
Ron, I've got a question for you though, because you always get to do the panels, but I have a question for you. Because I haven't been involved with FASB for a particularly long part of my life. This has now been like 4 or 5 years that I've been involved with it. This seemed really quick to me. Did this seem quick to you?
So, you know, the WSBA has a global partnership with AICPA. We have these conversations vis-a-vis FASB quite a bit. We've been doing it for many, many years. I think it's been on the docket of let's consider this for a long, long time, and no one gave a crap, particularly even when the micro strategies of the world, and you could say what you will about them, or the Teslas or the others are holding crypto on the balance sheet and they're taking the impairment, but holy mackerel, Bitcoin's at 60,000. We can't recognize any of that value at all. I think it's been under semi-serious consideration for some time. But Joe, to your point, I think there's a lot that needs to be vetted out here. You mentioned one size doesn't fit all in the crypto world, and God, I wish the regulatory platforms and regulators would see that. But I want to ask a predictive question, Pat, of you and Joe. In light of these criteria, in light of what FASB is talking about, and assuming that we get some criteria that makes sense in the next several months, are you anticipating a whole bunch of public companies will be like, this is great, now we can hold crypto on our balance sheets?
Yeah.
What's the impact of this from an adoption perspective?
Yeah, and so if you go to the next slide too, just to throw it up there, like there was this 1-2 punch of enterprise adoption that gets me incredibly excited, which is the FASB kind of notification and vote, and then the Ethereum merge, which is, there was two things that have kept. If you look at someone like, let's take like GE, is I always pick on GE, and I don't know why, but it's because they're right at that perfect intersection of like technology, supply chain, finance, where Web3 is going to impact their business. But they're also a conservative business, right? So they're a conservative business. They also have, they always have very public ESG goals, right? They're always talking about environmental sustainability. They have a huge wind farm division, all that kind of stuff. So I love picking on GE because they are the company that was sitting on the sidelines because of they're a company like GE is going to have a very powerful CFO, right? Like next to the CEO, probably the most powerful person in the company is the CFO. And if you tell them, hey, we're going to buy a bunch of stuff, and every once in a while, you're just going to take a massive like loss on your P&L, and like, don't worry, the public markets will understand. He's gonna be like, what the hell are you talking about? The public markets don't understand. I'm not doing that. Get out of here. And so you have one part of so finally you say, okay, we can actually bring ETH onto our balance sheet, because ETH strikes me as like an absolute clear-cut one that is covered under the FASB rules. So we can bring ETH onto the balance sheet. We're not going to be privy to weird fluctuations and one-way decisions of impairment, P&L expenses. Yep. Second, then the merge comes along and cuts energy and carbon impact by 99.5%. And so at the point at which you've now cut carbon impact, they can very much say, hey, we're looking at Ethereum because we can hold it on our balance sheet. We're not going to get dinged by Wall Street for doing that. And it lines up with our ESG goals that we've been talking about. It moves us towards a more sustainable future. And all the other benefits that we already all know about for crypto, which is we can now use it within our finance groups to do direct servicing of loans to individuals or companies, whatever it is, like all that kind of stuff. So it ends up being like a really, it was 2 weeks that I think are going to sort of fundamentally change the next, 50 years of enterprise finance is sort of how I think about it.
Pat, while we're on this topic, and for both you and Joe, let's start peeling back the layers a little bit on the merge and the move to POS and proof of stake. I want to comment on sharding a little bit, but let's really start peeling back the layers on accounting and taxation and the implications for those who are staking now. That the mining community in the ETH world has kind of evaporated. I know they're still out there, but what does that look like in the future? And then we'll weave in why sharding is important there as well from a volume perspective. But let's go deep. What does this mean for those who are staking in Ethereum?
Joe, you want to talk a little about like what the treatment, if you were staking before the merge, right, like before there was any guarantee that you could ever pull your money out, right? What that looked like versus now where we actually have a very clear roadmap to be able to get my money out of the stake.
Yeah, I mean, it really brings up, and I think I make this point from time to time of like, sometimes I think in the crypto world, we feel like we don't have any rules for us, when in reality, like, that's not really true, right? Like
we just don't like the rules all the time.
Right. There are rules, but what it requires is like a real foundational understanding of like, what are the transactions, what is happening, and how do we translate the rules that we already have for revenue recognition. Like, let's look at 606. Like, what does it say? What is the performance obligation? Like, what are you doing? When did you earn the revenue? And so, you get into, you have this, well, one, you're locking up your tokens for an indeterminate amount of time. So you have sort of, you may fall into this, like, sort of like irregular non-cash consideration bucket, right? And so those are the kind of hoops that you're jumping through. I think post-merge, you're still looking at the same rules. It just is a bit cleaner as far as, to me, as far as like RevRec goes. And this is also where I think it becomes easier to get that data, right? To get that, if you're validating, if you're operating, getting that rewards info, there's real, whether it's on, Beacon Scan or whatever it was, there's always this element of like, are we getting complete info? Are we getting the rewards info? Are we lining up the receipt of those rewards with our performance obligation, right? When we satisfy that. And then it's sort of, we could talk about with ETH Merge, but it goes for like kind of all proof of staking, which is like all proof of stake validating, which is like, hey, when you get these rewards, what is it? When are you recording it? Is it when it hits your wallet? Is it when you satisfy your performance obligation? Now you have a pricing issue, right? If there's a lag in time between when it was quote unquote earned versus when you actually, when they hit your wallet. And this sort of goes back to, you were asking about volume before, which is, we talked a lot about the maturity of the industry. I think what we are seeing is practical considerations for scale. Like we could talk accounting theory all day. It's like, can you do it at scale? Can you do it at volume? And I think this fits like right into that wheelhouse.
So Joe, go ahead, Pat. I'm sorry.
Oh, couple of things I'll mention for people if they have clients that are doing ETH2 staking, which I'm sure a lot of people here have clients like that. So a couple little interesting tidbits within the world here. First of all, one of the big debates in the ETH2 staking world right now is OFAC compliance. So if you are staking, there's when you are building a block, there are sort of two schools of thought that you can ignore any OFAC sanctioned addresses, Tornado Cash transactions, or not. And it's kind of a little bit open for debate. Now, OFAC released an FAQ. Everyone loves their FAQs that seem to say that miners were kind of exempted from the OFAC sanctions, but I mean, people don't like messing around with OFAC. Like people mess around with the IRS all the time. People like messing around with the IRS. Like that's a different issue. But like OFAC is one of those things that like, interacting with a sanctioned address can get you 5 years in prison. People don't like messing around with it. So that's point A. So just something to mention to your clients if they're concerned. And there's ways to be OFAC compliant and OFAC non-compliant within, or not worry about it from that perspective. The other one is today, your clients are getting revenue. So you still have revenue accruing in your staking node that you cannot withdraw. So the attestation revenue you get day over day, you can't actually withdraw that yet. That's going to come 1 or 2 months from now. There's going to be another fork when you're going to actually be able to withdraw that. But you are getting chain tips and other when you mine a block, you actually specify an address and you will get rewards directly to that address. So you do need to make sure that your clients are correctly, that revenue does not fall into any of these other sort of like deferred revenue and this other stuff. That is real revenue that when they mine a block, hits their wallet that they own at that point. You have to make sure that they're actually doing correct rev rec for it, pricing for it, all that kind of stuff. So that's the two things to just be aware of if you have clients doing this stuff.
Pat, Joe, just for the benefit of the audience, most of whom I assume know, but some of those who may not know are kind of new to this. Can you give the brief 20 seconds on Tornado Cash and why that's important? Joe, you want to take that real quickly?
Yeah, sure. I mean, Tornado Cash is a protocol, and Pat can speak to this technically much better than I can, but it's essentially like I'll call like a mixer is a term that gets used. Essentially, it's like if I want to make it unclear of like where I'm sending some assets to, I can use a service like a Tornado Cash, which mixes up my assets with a whole bunch of other assets and then sends it through this complicated chain of, stuff that I don't understand to end in the final destination where I want it. And so, I think the rub on a service like Tornado Cash is that it's used by bad actors, right? It's like if I just hacked some DAO for 10,000 ETH, well, I can't just send it to my Coinbase account and extract it because then they'll find me. So I got to use something, and that's why a service like Tornado Cash came under a lot of heat.
Yeah, the wrinkle to that is that when there was that Mango Cash hack that just happened, Mango protocol hack that just happened. That the hacker there took that token, a bunch of the tokens he hacked, and immediately put it into curve pools and actually liquidity pools and things like that. So essentially, all of these pools are somehow, whether it be something like Tornado Cash, which is a mixer, or even just any other DeFi pool, they're starting to get polluted with kind of dirty tokens. And that's going to be a really hard thing for us to deal with as a industry and for the US to deal with as an AML country, because it's not at all clear how you intelligently deal with that. I mean, that's where something like Maple Finance, this is a DeFi protocol that does KYC AML before you go into the protocol. Really, really cool stuff. I think we're going to see more and more of these kind of KYC AML DeFi protocols just for this exact issue.
Yeah. Pat, Joe, thanks. And one last point on the merge, and one of the interesting things here is sharding. And Joe, I'm going to go back to the volume and kind of throughput comment you made a bit earlier. And I think a lot of people lose sight of the fact that at least the non-technical people or those not deeply involved in crypto, sharding is really that force multiplier in my mind for transactions volume. That's what gets Ethereum, POS to Visa, MasterCard levels and beyond. What are the challenges there, right? What happens when we're talking microtransactions, for example, and 100,000 or a million transactions a second? And that might be further down the road, but what are your thoughts on how complex your job gets as a vendor provider in this space?
Yeah, I think it's really interesting. I totally agree. I mean, it's almost like, okay, the ETH merge happened. Now it's like scaling solutions, right? So some people are big fans of like, layer twos, roll-ups, whatever it might be. But scaling solutions. And I think if we correlate it back to maybe the traditional world, like Pat brought up, the number of transactions is like a Kohl's or like some big retailer. Well, they don't record, Kohl's doesn't record a journal entry every time I buy a pair of socks, right? And we are still sort of in this world where, we're bringing in people's transaction volume and they have to account for them. And I think the more sort of like sophisticated up in scale you get, there is an understanding of, we have to do something with this volume. We don't want to record every transaction in our books. There is some aspect of batching or grouping or rolling stuff up. And I think as we move to a micro transaction world that is facilitated via sharding and these other strategies, I think that is going to be the big thing. But Pat, I'm curious what your thought is.
Yeah, I could have said that myself. I mean, the way to think about scaling solutions is you get magnitudinal effects as you go up the scale. So we already are starting to hear people talking about L4s and L4s. It's at that L3, L4 layer where you get to millions of transactions per second. I wouldn't say I'm scared about it, but like, it's gonna be interesting because again, like you get back to it is that part of the issue is that it's sort of a great power and great responsibility kind of thing, which is that you are going from 0 to 1 billion transactions with a one-person finance team. It's really, no one else does that. Like no one has ever seen the scale, the speed of scale increase that we run into. And so it just puts more pressure on tools like ours to be able to handle that volume, but make it simple enough for, two accountants on a corporate team to be able to handle. That's where a lot of the trick comes on this stuff.
Joe, when Pat he'll just bring quantum computing online, Pat.
Yeah,
a year or two, and then
he's probably already working on it. I don't know.
We're pretty screwed once we get, because that's going to make Bitcoin. We're still not quantum proof on Bitcoin, so we're all hoping that doesn't come along too quick.
Every once in a while, I do wake up thinking like, AI, quantum computing is going to do a Bitcoin double spend, and it's all over. I don't know.
we're all done here.
I want to have one comment, and this is sort of a tangent, so sorry, Ron.
No, go for it.
One of the most interesting things that I'm like dying to find out as time goes on is as the scaling solutions get in place is what are the transactions that still live on a layer one, right? Like what lives then on ETH layer one? I think I've heard a lot of people say, maybe it is the global settlement layer because,
right.
If you're sending $100 million via an ETH transaction, you don't care about fees, you don't care about anything, you want maximum security, and so what I'm really curious is over time, what happens to the layer one as the scaling solutions scale up, and who still lives and transacts on layer one.
Yeah. We're getting too far in the future here.
I have no idea.
But it's there's
a lot to talk about here.
It's a good point. That's probably going to be our next webinar with you guys. But it really mirrors the internet conversation, Joe, that was happening 40 years ago, which was what's the base layer, and now HTTPS and then www. And I know that's an overly used, overly hyped example, but that's exactly what you're speaking to from the perspective of crypto.
It's an important way to think about what I talk about that a lot when we talk to analysts and investors and things like that, which is people tend to think of Web3 as an industry, right? They're like, oh, the Web3 industry. People like Bitwave and Optimism and Polygon. Like Web3 isn't an industry. Web3 is a enabling technology for total financial financial programmability, and it hits every single industry that we can possibly imagine. And there's sort of like the internet like that, which is that early on people did say, oh, the internet industry. talking about pets.com and stuff, not
Yeah.
thinking about how the internet is going to change their bank, their gym. I mean, who thought that the internet 40 years ago was going to fundamentally change the nature of their personal club that they go to? But Equinox couldn't exist without their app. So it's really, it's an important way to think about Web3 as that underlying layer, no matter what.
Yeah, and Pat, you might have been the one who said this at one of our events or a while back. You know, at some point, everyone became an internet company in some way, shape, or form.
Yeah.
In some way, every organization will be a crypto organization in some way, shape, or form, just by the tools that they use. We still got a lot to cover. Folks, I know Q&As are coming in. Please keep them coming in. I want to move to the next slide a little bit, because one of the important things that Bitwave's been doing, Pat and Joe, you spend a lot of time working through and thinking through emerging real world use cases. Let's dive into that a little bit. There was some new news on, I think it's Roofstock and sales of NFT-based physical real estate. Do you want to dive into, I mean, let's talk about fractionalized real estate tokenization of assets. What does that world look like for you, for Bitwave, and what can we all expect to see in the future from those industry groups?
Yeah, this is super cool stuff. The two that I'm going to call out here. So on the fractionalized real estate, what we saw over the weekend was Roofstock sold a house in Columbia, South Carolina as an NFT on OpenSea. It was 175K, and someone bought it, and it was essentially structured as a full deed to the house sold through an NFT. So this creates some really interesting discussions around the FASB issue earlier. Is that really non-fungible? Is that an ASC 815 derivative? Like, how exactly are we going to treat a property like that? And I don't know the answer to it, but it is. I actually very fundamentally believe that, like, I like to think about the world in terms of the crypto world in terms of the summer of, like, because that's sort of how it sort of works. Is like, 2018 was the summer of, or whatever, 2020 was the summer of DeFi. DeFi just exploded. Everyone went crazy. 2021 was the summer of NFTs. Oh my God, everyone, you couldn't turn around the world talking about NFTs. There was a million transactions a day on OpenSea. 2022 was kind of the summer of winter. Which is all anyone wanted to talk about was the bear market and winter and stuff. But 2023 is gonna be the summer of tokenization. Like, everything's getting tokenized. And so that covers things like NFTs. Roofstock moving into this is really cool, because Roofstock's main business is not just selling the houses. It's basically packaging them up and then letting you get, they'll do all the management. You buy it, they do the property management, and you just get a check. Fits incredibly well in a world of tokenized assets. Like, that's exactly, we have a company that's a customer realty that does that. That's exactly what they do. So that's kind of on the fractionalized real estate side. On the tokenization side, you saw KKR get into it. When KKR moves, things are about to get real. Like, those guys don't move just because they're bored. I mean, this is the barbarians at the gate guys. So, and I thought it was such an interesting use case. So KKR announced that they were tokenizing, one of their portfolios, $4 billion. I think that's like 1/1,000,000th of their actual holdings or something insane like that.
They hold a lot.
Yeah, but it's, they still are moving to tokenize it. And it occurred to me that it was a really interesting move, because traditionally, KKR makes their money, buying companies, dividing them up along business unit lines, repackaging them and selling them out, and then sort of maximizing the efficiencies they can from the companies. That's what a company, a leveraged by a LBO company like that's going to do. But there's actually a world where that fits in really nicely with tokenization, which is you take a company that you own, but instead of sort of carving it out for to be sold off to the highest bidder for different business units, you can basically tokenize different parts of those companies and sell those out to give access to people like me who normally wouldn't have access to KKR resources. So it's another way of slicing and dicing a portfolio of assets to sort of maximize the value without necessarily, and I'm going to say this is sort of a little speculatively, but like, without necessarily being as destructive as a normal LBO would be, where you're really tearing a company apart, firing half the people and things like that. It lets you kind of tokenize in a slightly different way. So those are the two that really jumped out as me. And we're going to see, I think over the next year, we're going to see all different stocks come to the blockchain. Like today you could buy Tesla, but I'm pretty sure we'll see every single different stock you'll be possible to buy as a token on the blockchain. All that's going to happen. So yeah, that's kind of what we're seeing here. And it's really, it's going to be complicated from an accounting perspective.
Pat, Joe, from that perspective, just to dive into that a little bit, when we talk about things like fractionalized real estate or tokenizations of assets, the big thing about the KKR announcement is bringing us back to some of the first principles that I remember the three of us were talking about in the early days of blockchain and crypto, which is this technology helps to remove friction from the system and offers up access in a way that didn't happen before, which is a good thing, arguably, right? When we look at KKR, and it was their healthcare fund, interestingly enough, that they tokenized for greater access. And the ability to remove friction means that there's greater velocity of capital allocation. They can move assets more cheaply, more efficiently, more effectively. But putting back our accounting and kind of vendor perspective hats on for a moment, there's massive opportunity there as well for a Bitwave. Talk about what that might look like over time. What happens when most private equity firms have all of their assets and allocate them to investors on a blockchain, or when Joe can sell his house on a blockchain within an hour, for example, or less, versus paying a ridiculous amount for title insurance, for example. What do you think about that future? Is that a hey, that's going to happen in the near future, or that's a Ron, come back in 100 years and tell me what you think about it? Joe, I'm going for you with that one first.
Yeah, I'll go first because my answer is probably less popular, which, like, you know, and maybe this is like, maybe sometimes I'm a bit jaded. I think some of these areas are still clunky, right? Where we are still trying to connect the crypto world to the physical world. Like, it's amazing that house was sold as an NFT, but it's like, well, did they still have to record the deed at their like county, you know, at their county clerk's office?
Did they just bake the title insurance price into the NFT that they sold and all that stuff?
If somebody else is squatting in their house and they call the cops and say, get this person out of my house, do they pull up their OpenSea profile to say, like, no, this is mine? Like, there is still requires, like property rights are enforced physically, right? And so I think there are still some clunkiness in that connection. So I think, but I do think there's a scale to this, right? Like, honestly, real estate and getting rid of that clunkiness might be the hardest. I think there are easier ones, right? You know, like tokenizing equities, like, sure, there will be consumer protections put in place. There will, right? Like and there should be, right? Like, you know, the SEC, the CFTC, everyone's, you know, like hawks circling around. And we need some rules. So I think we'll move along that friction path sort of accordingly, of which require the least physical world enforcement, and those ones will be adopted last.
I remember this really well. Like maybe like 5 years ago when we were just starting Bitwave, there was a startup I came across that was I was like talking with one of the founders, and they were talking about how there's this issue, and it was Kenya, Nigeria, it was one of the African countries where there's such bad title records that people would just squat and take over land. And then what would end up happening is you'd have like 3 people that all had the same title to the same land. And so they were doing a startup to fix that on the blockchain. So it was a blockchain startup that was going to fix that. And like, it was a super interesting idea, and it's a great notion. But at the end of the day, like, you know, that's not a blockchain problem. Like, that is a first and foremost a political, like, legal, you know, institutional problem. You have to sort it all out. And then only after you've sort of solved all the underlying claims and all that kind of stuff, can you really then put this on the blockchain and let it go forward. So there's like, we're years or decades away from actually getting a lot of this stuff in a point where we can get real value from it in that way.
Yeah, Pat and Joe, I think you're right. I mean, there are certain segments of the global economy that are very legacy oriented. Joe, to your point earlier, I mean, we worked with some municipalities around the United States, and their title and registrations are in big old dusty books in a basement of town hall. That doesn't really, blockchain is not the solution out of the gate for that, but you can envision a world where at some point in the future, the next new title for Joe Dillon Construction Company is going to be registered on a blockchain. And that's when you begin to see that kind of evolutionary change. So as we move
that'll happen as new cities come together. So a new city incorporates, you know, there's that city they're building in the Middle East. It's like the, you know, 100-kilometer long, like, I don't know if you guys saw that on the news, but like they'll probably have all the titles for their condos and stuff will be on the blockchain. And that's like a great way to sort of do it. And that's going forward, they'll have it there. Yeah.
So as we look at legacy industries that kind of have a lot of that baggage, I'll call it, we start to get into this, I don't want to use Web3 or kind of 21st century stuff, but let's go off script a little bit and talk about gaming.
Yeah.
In that respect, and let's tie this into from an accounting and tax perspective, there is a coming wave of gaming capabilities that will be hundreds of billions by some estimates or more. We can make fun of Meta all we want, but those will have real world economic impact. Pat, Joe, do you want to talk a little bit about, do you have gaming customers? And maybe you can't talk about that, but what does that future look like from an accounting perspective as well?
Yeah, gaming is one of our biggest verticals. We have a very, very huge crosscut of the GameFi industry as a Bitwave customer. We're big fans of it in general. What I tend to talk about for gaming, and the reason that people get so excited about crypto for gaming is that virtual currencies have been a part of gaming for 15 years at this point. We were joking about this yesterday, which was that the IRS just released a new little FAQ. It wasn't even an FAQ, it was a little note.
It was a draft of the 2022 1040.
Yeah, draft. And they finally changed the verbiage from virtual currencies to digital assets on there. And I was joking that so now I don't know how to actually treat my World of Warcraft gold. I'm gonna have to go and do a 606 analysis on that to understand what I should be doing with it. But gaming has had virtual currencies and this forever. And there's actually, it was well before crypto, there were people making money,
yep,
mining gold in World of Warcraft and selling it. And so it's such a natural progression up there. And I like to sort of think that the reason it works really well is it ends up being a choose your own adventure for gaming. If you are someone like me, I play video games, I love gaming. I haven't picked up a controller in probably 24 months. But if I were to, I don't have time to grind. I don't have time to go in and if you ever see that, there's that South Park episode where they have to kill 1 billion pigs to get the levels that they need to. I don't have time to do that. And so for me, I would throw money at the problem. I would rather just buy the nice sword online so that I can have a fun gaming experience without getting the grind. Whereas, some kid in college who has a lot more free time than me, but does not have money would rather just do the grind and experience that way. So it lets you kind of pick your own it lets you pick your own adventure. It lets you kind of pick your own way to interact with the game. Do you want to grind? Do you want to just play, pay to have a power character? And it's one of the really powerful parts of this. It's really, people were already making these decisions, and now we're just turning that into an actual economic function.
Joe, anything you want to add to that before we move on?
Yeah, I just think it's such a good example of what you mentioned, Ron. So kudos to you of as far as friction, I think people are so excited about the gaming space because it feels the most ripe for this, right? It feels like the rails are already in place. We already have these mechanisms. We already have these in-game stores. We already have an in-game currency. We already have, and so I think it just seems so ripe for it. I think, part of the maturity we talked about before is well, what does it actually mean to do that? Are you holding those at, you talk about volume, micro transactions. How do you deal with the volume? How do you deal with the scale? Are you distributing those tokens? Are you just maintaining them on an internal ledger? Are you actually sending them to someone's wallet? So now are you a custodian for those tokens?
Right.
So now do you have to make SAB 121 considerations about your books there? So I think and I think it is. We
haven't even talked about SAB 121 because all the gaming companies are having to deal with that, which is so interesting. You're seeing SAB. Okay. To talk about a very real world use case right now that is an enormous question in the industry, SAB 121 as it applies to gaming companies for their NFTs they're holding for their clients. So a lot of gaming companies custody their clients' NFTs. So I'll always go back to World of Warcraft. They don't use NFTs, but I'm sure they will. I kill the bad guy. I get a really cool sword. I don't necessarily transfer that directly into my wallet that I control. Blizzard might hold on to that for me. Are they now a custodian of assets? Under SAB 121, yes. Are they now having to do fair market valuation of NFTs under SAB 121? Yes. Is there any guidance in the world on how to do fair market valuation of NFTs? No. And so you're in this really hard situation where you are a custodian, you are tracking these things, but you are still making up a lot of the rules as you go along to figure out how you're going to value these NFTs that you yourself mint. There's already this conflict of interest if you're the minter of the NFT and you're doing the valuation and you control the market, all these sort of weird things come into play there. But that's something that we're seeing today from clients.
Pat, Joe, to set some foundation for some folks who may not know, and I suspect they do, but SAB 121, the SEC's accounting bulletin 121 that was issued, Joe, remind me, was it 4 months ago, 3 months ago? I'm losing track.
More than that, I think.
Oh yeah, it seemed like decades ago.
Maybe spring, summer. I can't remember. It
came out of the
time. It's
came out of the blue, wasn't particularly expected, but kind of threw a lot of people for a loop. We're probably doing a SAB 121 deep dive. So Pat, Joe, you're going to be stuck with us again. We've only got a few minutes. Please do keep your questions coming. From the perspective of the slideshow and other things we wanted to cover, we did talk about POS accounting and staking and deferred revenue. I think we touched on crypto treasuries. And I wonder, can we dive into this a little bit more, Pat, Joe? What are your thoughts on crypto treasuries and how that's being operated?
Well, I'll throw one thing out there for this, which we don't have to spend a ton of time because we have some good questions to chat about here.
Yep.
Crypto treasury it's a Rorschach test. Like I love the term because everyone in the entire world thinks of it as differently. You talk to the operators and they think crypto treasury means your compound vault where you put money and you earn yield. You talk to the CFO and they think it means cash flow. So like you take one of our marketplace customers that all the revenue is crypto, all their expenses are USD. Like it's the most elegant cash flow FP&A problem. It's a classic treasurer problem. Like, am I gonna have enough money in USD to pay all of our developers 6 months from now? If I'm getting paid in ETH, how do I make those determinations? How do I set up hedging functions, all that kind of stuff? So that's a big part of it. The part that I'll offer that is maybe most relevant to a lot of people on this that you should be talking about to your clients or to your company is treasury considerations for owed taxes. So this is another classic treasury function that you would have at a big company. Treasury would be monitoring how much money you're expected to owe on taxes next year and kind of keeping that in reserve, making sure you have that as cash, not exposure to derivatives or other equities, whatever it is. And so a lot of our clients have had this situation, especially during the winter here, where they did something. They did an airdrop. They minted some tokens. They had a really successful NFT sale that netted them, $100 million. Then the tokens dropped down to $20 million in value due to the winter, but they're still on the hook for $100 million of revenue and the taxes that come along with $100 million in revenue.
Right.
So the treasury function that I think tends to be most overlooked and most important for a lot of crypto companies is keeping the eye on that the amount of taxes you owe next year and making sure you are properly carving out the money so you actually have the money to pay those, given the volatility of the rest of the assets. That's what I'll throw out there for this.
Perfect. Thanks so much. I think we've only got a couple of minutes and I do want to do some closing comments. Joe, Pat, if you guys are comfortable with it, I thought we'd hit the Q&A.
Yeah, great questions on there.
Yeah, a couple of great questions. And again, for those of you who don't have time to add the questions, you can email us. We'll get those in front of Pat and Joe as well. What are the biggest gaps in blockchain data at the moment? Bill Armstrong submitted that. And we kind of touched on that a bit earlier. Pat, Joe, what are you seeing in the landscape? You guys are plugged into the data on a daily basis.
I can take Bill's question and then Joe, you can take the Fred's question there. So the hardest part about this is there are every week there's 2 or 3 new blockchains. Like this week, the new blockchain was Aptos. Like that's the new blockchain this week. It'll have your clients will be on it because it's the hot stuff. Like it is the hot blockchain this week. So just be aware of it. When new blockchains come out, you end up having this mismatch in tooling. So it takes a while for a company like Bitwave. Like we might take a month to build an indexer for something like Aptos as it comes out. In order for us to have the full amount of data for us to use the full blockchain, might take us a couple of weeks, a month, something like that. In the interim, our clients are relying on downloads from the explorers. Well, with a lot of these when the newer a chain is, the less likely they actually have good downloads off their explorer. And so Aptos is a great example. They're probably not going to have a CSV download off of their explorer today for you to use. And we haven't had time to build the indexer for it yet. So you're left in this gap where we will often use screen crawlers and screen scrapers on the explorers and stuff like that to get the data. But you are left in this really tough data situation where we haven't had time to build it. They haven't built the actual export. How do you work with that data in an intelligent way? Because you as the accountant don't get to tell your product team, don't touch this blockchain, I can't account for it. Like they would laugh at you. So you still have to have a way to handle it. That's where the biggest gaps are. And we have some stuff to deal with it for our clients, but it's always a challenge.
Yeah.
Pat, thanks. Go ahead, Joe.
Oh, I was just going to say it ties into like something that we talk about internally. Sometimes it's like enterprise readiness of a chain, of a network, of like they have a block explorer that you can export things. And you're right, Pat, the accountant saying like, hey, don't operate on that network because I can't get, it's like, yeah, whatever, man.
Thanks, bro.
yeah. But it is a consideration. And it is something we talk about with our customers who are in that planning phase of, do you want to operate on this network? How enterprise ready it is? Does it have the support? Can you get the data? All of these, there's this whole bunch of considerations to make.
Pat, Joe, thanks so much. We got a couple more questions coming in. Pat, let's stick with you. Fred's question, what are the things to consider when determining the floor price for a newly minted NFT for gaming use?
I'm going to kick this to our resident NFT DGen, Joe. So Joe loves NFT pricing more than anyone in the world. So Joe, take it away, my friend.
So I'll go quick. Answer is the market, right? How do you determine what the price is? What is the market willing to pay for it? What could you sell it for? But the question was like, how do you think about floor price? It ties into this bigger issue of NFT valuations of how do you value an NFT? And I think a lot of people immediately, they go on OpenSea and they look at the floor price and they're like, okay, well, it's at least worth that. But there's a big caveat to that. I honestly think that's wrong. You have to remember the floor price represents an offer to sell at a price. It is not an offer to buy. Now, OpenSea does they'll show you like collection offers and stuff like that. But if you look even at the biggest collections, your Bored Apes, your CryptoPunks, the sales price, like what they actually sell for, is actually on average typically like 10 to 15% below whatever the floor price is at a given time. So that's something to keep in mind. I mean, we could do a whole nother session on NFT valuations. What I'll just say is it's an immature topic in the sense of it is nuanced, it is complicated, and we don't have clear guidance.
People hate floor price too, because it means that you almost never actually buy at the floor. You usually buy somewhere above the floor. So it means that if you buy an NFT, you essentially pick up a usually pretty major impairment day one if you're using floor price as your fair market valuation. So people don't really like that. We've developed a lot of mechanisms to do NFT pricing. We're still figuring out exactly what the right one's going to be, but using multiples and like, there's a lot of different ways to kind of look at how you build up these models so that you're not just taking an enormous impairment the first day you own an asset, which seems kind of counterintuitive to the way this stuff is designed.
Exactly. Pat, Joe, real quickly, I just want to cover Amanda's last question and then do some closing thoughts. But this is a really interesting one. What are some of the accounting treatments you have seen for hacks?
So this is an interesting question because you can just take it as a loss. Like you can just do a straight treatment as a loss there. The problem with this question that's so hard, or like the thing that makes it so hard, is it's not always obvious what has been lost, right? So that's the really, really hard piece here.
Right.
So let's take the Mango Finance hack that happened over the weekend, which was an arbitrage hack where it is, if you were to look at their website while the hack was happening, it was not obvious that the value of the tokens that you had in the protocol was going down, because they were exploiting. They were basically arbitraging away, exploiting a kind of a loophole in the code that meant that the price that was represented on contract was not actually representative of what was happening to the underlying assets. So you might log into Mango, you might look at your holdings. It might say you have $100,000 in Mango, but in fact, all of that had been arbed away, and you in fact had $0 in it. So what we've seen is the hardest part about this. The treatment itself, you can pick it up as a loss. Joe can talk a little bit more about how you do that over time and things like that. But the hardest part is it's not at all obvious what was actually lost, and the data that you're going to be relying on. Often in these hacks, the data itself is what is hacked. So like you can't just go to the website to look at your current holdings. You have to do some sort of other analysis. Like you have to look at the actual assets in the pool, figure out your percentage, use that to calculate your real holdings, completely irrespective of what the website itself is saying, and then get to a valuation that you can do. And even after all that, you might want to burn the tokens or something else like that to prove that you have really had a loss. Joe, anything to add on like what period you would?
No. I think that's fair. And I know we're at time, so I think that was good.
We're at time. That'll be our next conversation. Pat, Joe, always a privilege. I feel like I say this every time. We're just scratching the surface. There's so much to dive into. for people in the audience who are with us, where can they learn more about Bitwave? How can they reach out to you guys directly?
Bitwave.io. And there's a contact us button there. If you want to follow us, we're at Bitwave_platform on Twitter. We are, I think, /Bitwave on YouTube. Maybe just search for Bitwave on YouTube. We do a lot of like fun videos and stuff like that on YouTube. So yeah, I would love to talk with everybody.
Excellent. Pat, again, Joe, again, really do appreciate it. Really admire the team at Bitwave. You guys are doing a lot of great stuff. For those of you in the audience who joined us, this recording will be available in about a week or so. Thank you for joining us. We'll leave it there. Thank you, everyone.
Thanks, everybody.
Take care.